Hello, everyone, and welcome back to Smart Money Results. With the economy signaling massive troubles ahead, the Federal Reserve has no choice but to act in an increasingly dovish manner. To help protect yourself against this coming monetary crisis, please go to smartmoneyresults.com/inflation. And here to discuss the current economic landscape is Brien Lundin, President and CEO of Jefferson Financial. Through this leading organization, Lundin publishes the Gold Newsletter, which is quite literally the gold standard of precious metals-based advisory resources. Furthermore, he hosts a New Orleans investment conference, which has brought together the biggest minds in business and politics. Mr. Lundin, thank you so much for joining us at Smart Money Results.
Great to be with you, Joshua.
Thank you. I'd like to start by asking about recent developments. As expected, the Federal Reserve just cut interest rates, although by a more modest amount of roughly 25 basis points. Yet the gold and silver price collapsed on the news, even though the Fed is still being dovish. Can you explain to us what's going on here?
Yeah, well, they just weren't quite as dovish in their statements and their estimation of the U.S. economy going forward as we would expect. One of the things that's really driving this rate cut has been the disparity between the rates in Europe from the ECB, et cetera, and the U.S. U.S. rates are still higher, far higher than around the rest of the world, which the German Bund is at a significant negative rate right now.
Yeah.
So the concern there is that with U.S. rates so high, that it distorts the U.S. economy, money flows, et cetera. So the Fed's rate cut this time, I think what they're trying to signal is due to extraneous and exogenous factors like that interest rate differential. What they're not admitting or acknowledging is that they're kind of the whipping boy of Wall Street right now and at the beck and call of Wall Street. And Wall Street has been clamoring for this cut, in fact, more cuts. And the Fed is really reacting to that. What they've done since the 2008 credit crisis is to build an economy that's based on the wealth effect. That is pumped up asset prices for real estate, equities, et cetera. So the old adage that the stock market isn't the economy is no longer true. In this modern age that the Fed has created, the stock market is in fact the economy. And so if they allow stocks to decline in value significantly, they're going to really hurt what they have built. They're going to knock out the foundation, the shaky foundation of the current economy and put the recovery in danger.
That's a very interesting point. It's also a very startling point because I recently read a statistic that the total stock market capitalization, the valuation of the markets is 144% of last year's GDP. Which suggests that we're really talking about just massive speculation. I think in previous generations, it was much more of a reasonable ratio that the stock market represented 30-40% of the annual GDP. Which I mean that again is a much more reasonable ratio. Now, as you had also mentioned in a previous interview, I believe you used a term that the Wall Street is basically holding the Fed hostage because they desperately need their QE juice. And of course, you just said that the Fed is also under pressure from the Trump administration. With just that these factors alone, it just seems like gold is almost guaranteed to rise. And I'm not asking for a specific price target, but is it a fair point to be for regular investors to be so bullish on safe haven assets like gold?
Yeah, it's a fair point that they should be bullish. I'd take it further. They have to be bullish. They have to recognize the fact that if nothing else, the debt load in the U.S. at this point, and really all developed economies, the debt loads are so great now that it will necessitate the valuation of the currencies that they're denominated in. There's no other way around it. It's a simple mathematical certainty at this point. So everyone who has significant assets really needs to protect themselves, primarily through some physical holdings of precious metals. Bullion, silver and gold bullion that's readily accessible, not in a bank vault. That's the first step they need to take. If they want to get to leverage this rise in gold, this seemingly inevitable rise in gold and silver prices, they can get involved in the mining stocks. And depending on what level of involvement or effort they want to put forth, they could just invest in the major producers or the big indices like GDX or GDXJ. Or if they want to get involved and learn more and potentially ramp up those returns at significantly greater risk, of course.
Sure.
But if they want to look into individual stocks, particularly the juniors that are very leveraged to this move, they have the potential for really outsized gains. Again, greater returns, greater potential brings greater risk. But if they can mitigate those risks by taking the time to go to conferences, by subscribing to some of the best newsletters out there, talking to companies, meeting them. It's a lot of fun. It's interesting. It's a great place to put a portion of a portfolio. And it can be extremely profitable when the underlying metals are in a long-standing, long-term bull market, like I believe they've begun.
Speaking of the mining sector, so back in 2014, 2015, there was a massive deflation of energy prices, and we saw many oil companies, energy companies that took massive hits. I guess one of the consequences or result of that downfall was that the energy stocks that are available now have made it through that. I guess you could call it the baptism of fire. And is that a similar dynamic with the precious metal stock, that those that survived the prior crash? I think it was in 2013, 2014. That the sector is much more leaner and meaner than it was just a few years ago.
Yeah, definitely. These are the survivors. They're generally, if they're producers, they're in better shape, they're better balance sheets going forward. There are a lot of other factors involved with it. A lot of the juniors have run out of money, very recently run out of money, or they inflated their share count to really stay in business because they don't have ongoing revenues. So you need to look into the plumbing of any individual mining stock. Look at the share structure, look who's involved, et cetera. Look how much money they have, and do they have an ability to raise money in this environment. Even though it's better, it's still not that easy to raise money. So you have to look kind of behind the scenes. So yes, and another factor is that a lot of the companies from the last cycle aren't around anymore. So the money that comes into the sector is going to be focused on fewer plays that are there. So if you can find the good companies, well-positioned companies now, the money is going to be spread over fewer companies, at least for now. So the reactions will be a bit more dramatic.
I see. As within the mining sector, there's diverse business models. Obviously, there are companies that mine and produce the metals, and then there are those companies that employ a streaming or royalty based model. Is there any particular system that you're eyeing, or does it matter at this point?
There's a lot to be said about all of those different sectors, and it does get very complicated. Okay. It takes a lot to understand gold and why it's moving. Then as you get into the equities, there's so many different ways to play it, from the producers, the major producers, the mid-tier producers that might have a steeper growth curve. The royalty companies are great plays. They tend to be very responsive to the moves in the market. They're also a bit more highly valued on an EPS level because they have pretty thick margins and they don't have the hassles of operational risk, et cetera, in running a mine. So there's a lot of different ways to play it. I like when the metals prices are just beginning to move. I like to find companies that have large resources. Maybe they're not in production yet, but they have economics. They're defined and they're large scale. These so-called optionality plays can move quickest and earliest in a bull market move. And there are a few plays like that we like that have yet to make big moves that we think are poised to do so.
I'd like to shift gears back over to the broader economic circumstances. So one of the biggest developments thus far is the drone strike against Saudi Arabian oil supplies. And it just seems that we may be on the cusp of yet another conflict in the Middle East. And yet the markets remain relatively calm or muted regarding these issues. How long do you think before we start to see these genuine concerns or fear price themselves into the broader investor sentiment?
Well, I think they do get priced almost immediately into investments. And that's kind of the problem I see with betting on those geopolitical flashpoints, as it were. They're priced in and then they're quickly priced out. By the time you've reacted to it to buy gold, some Sharpie has already done so and the price is already up. And by the time that Sharpie or those traders leave the trade, you're not going to be the first one out. You're going to be left holding the bag. So I think there are plenty of reasons to buy gold and silver that are divorced from the geopolitical crises, the headlines, and that all these things do is kind of create blips along the uptrend line. I think we need to focus on the longer standing fundamental issues of monetary debasement, massive debt burdens that argue or really make inevitable the fact that we're going to have ultra low interest rates, probably negative real rates as far as the eye can see, and an ongoing devaluation of currencies. That's enough to make you need to invest in gold and silver. And I think we need to kind of ignore these geopolitical issues as they come up.
It's interesting, though, when you talk about issues like the debt. A couple of years ago, I remember that I was freaking out when the national debt hit $16 trillion, and because it matched the GDP at that time, it was a 1-to-1 ratio, and then nothing quite dramatic happened, and overall, there wasn't a massive crisis event, and people, I guess, got used to $16 trillion debt, and then it kept getting higher and higher, and now it's at something like 22 or 23 trillion dollars. And even at $20 trillion, that seems like such a psychologically significant benchmark, and yet it just because the debt is so big, just servicing that debt itself, you just can constantly add trillions over the long term. Do you have any idea, like, what is the magic number, if you will, of the debt before it just starts to? Because people really don't seem to recognize, like, I see people, they're just going on their daily lives and, everything's okay. Unemployment is technically near multi-year lows, and there's a seeming calm, and yet these core metrics like the debt just keep piling up and up. Is there a certain point where it just becomes untenable?
Yeah, I think it is, and I'm kind of cynical about this. You say you watched it for a few years. I watched it for a few decades,
Yeah.
and running an investment conference in the hard money industry, you can imagine that I've heard people talk about the debt bomb about to blow up for better part, well, over 30 years now, and some really smart people, very highly respected people, friends of mine that have been on our stage talking about the debt problem for literally decades, and nothing seems to happen. Um, but I've come to the point, where I look at it and I think it's a mathematical certainty that within the next few years, it's all going to come to a head. And I think that's kind of what we're seeing in gold and silver, the market and investors starting to realize that. The debt doubled under Bush, it doubled again under Obama. If things hold true, if that trend holds true, it's going to double again under Trump if he goes 8 years, and we're going to have debts of close to 40 trillion uh, by the time he gets out of office. The right now we're running a deficit of $1 trillion for the first time in a few years. So spending has soared, the deficit has soared. What people don't realize is with the deficit at about $1 trillion, that means the debt's actually going to grow by about 1.5 trillion because there's about 400 to 500 billion dollars every year that's off budget, that's spent automatically, that's on autopilot. So it's going to be 1.5 trillion higher. So that means we're going to be closer to 24 trillion by this time next year, or actually by the end of the year when you calculate everything. So it's growing tremendously. We cannot afford, even at these ultra low interest rates, to pay the interest on the debt. My calculations show that if the Federal Reserve would have been able to get the Fed funds rate up to about 3%, which was their first minimal target when they were trying to raise rates, that would have implied our funding costs, our debt service costs on the federal debt would have been on the order of $1 trillion. At that point, I think the public is going to say, why are we paying $1 trillion a year, more than defense, more than welfare, more than Medicare, more than any entitlement? Why are we paying this to these fat cat bondholders? Especially a lot of them across the world, even despotic regimes, even China holds so much of our treasuries, and we're sending all of these hundreds of millions, even over $1 trillion to these fat cat investors. Why are we doing this? Why don't we just not pay it? At some point, that's going to happen. And when that does, you're going to see the value of the dollar tank, and you're going to see gold absolutely soar. I don't think that's an eventuality. I think that's an inevitability. And I think that's the kind of a thing precisely the thing that investors need to guard against right now by making sure they're positioned in gold and silver.
That is, again, it's just a startling thought, a very sobering thought. I want to be careful how I ask this next question. I believe that every country has a right and has a necessity to protect their borders, protect their interests with a robust military. But it seems like the military overall, the whole defense industry has just become this this massive fiscal vacuum. I mean, I personally believe that our biggest threat is not necessarily the Russian or the Chinese, but rather that the Russian or Chinese military member is willing to serve and die for their country for pennies on the dollar. And do you see, because Trump loves talking about the military and spending more on the military, and we have these I think we just recently launched a new aircraft carrier, and it seems like the wars of tomorrow may be more digital than they are kinetic. who knows what's going on with the Pentagon and their black budget. Do we, if we, or do you see a situation where we just desperately need to cut down these sacred cows like defense spending to more reasonable levels to sustain ourselves because of this insanity in the fiscal environment?
Well, unfortunately, I don't know whether we have that luxury because I think we're actually far behind China and Russia. For instance, we're behind them in hypersonics because we never really developed that as we should, because we do have great advantages technologically and economically, and we should have been using those. Instead, we've fallen behind in that area, in cyber warfare, and a lot of other areas. I think what we have here is a problem to spend wisely in the military. It's an age-old problem. It's always been there. Militaries, the free market does things much better than government. The best thing government does is break stuff, which is why they can do that through the militaries. But even that would benefit from privatization. We really don't have, in the old days, we had the Lockheed Martin Skunk Works, and that developed a lot of the cutting edge technology. That's all fallen by the wayside, and a lot of that has been transferred to contracts with the likes of Google and organizations like that. There's not a lot of either good fundamental research and development and far-sighted research and development being done, and a lot of it's being focused more, and to some degree should, but a lot of it's being focused more on the cyberkinetics area, and a lot of that is being farmed out. So again, I don't think we have the luxury of cutting back on that kind of spending, and most of the other spending in the U.S. budget is, as I said, on either autopilot or, for all practical reasons, on political autopilot. There's no way you can cut back. You can't even cut back on the rate of increase in these spending areas without being accused of starving the populace and having drastic draconian cuts. So unfortunately, I think that eventually this means some type of a monetary reset in the U.S., whether it's this boom-bust monetary reflation cycle or the next one or the one after that. It's somewhere down the line. And again, the actual path we're going to follow, I don't think anybody can know in any detail. But one thing we do know is you should have gold and silver and be exposed to those sectors going into it.
Yeah, that is an absolute must. And the more that I hear the Fed going aggressive with their, they will eventually have to juice up the QE to sustain this environment. I just wanted to do one last hard shift. I wanted to get your general thoughts on the real estate market. As you know, in many key areas in the U.S., the price of the cost of living just keeps rising higher and higher. And it's at a point where I don't even know how people are making it, because many years ago you could have an okay salary and still do fairly well. And there were just ample opportunities. Now, for example, California has raised their minimum wage to $12 per hour, and I think that they're angling to get it up to $15 an hour, and which sounds great in theory, but everything else, especially the real estate prices, have exceeded the rate of the wage increases, and because of the inflationary policies, the wage growth is real wage growth is really stagnant. Do you see in the context of this monetary crisis, do you also see a real estate crisis with prices collapsing back down to more human levels?
Well, the Fed is going to do whatever it can to prevent that, because that's one of the asset assets that it tries to balloon and blow up through this massive monetary injections that it's done since 2008. We're not quite to the point where we were back then with the Community Reinvestment Act and the liar loans and everything else, but there are moves afoot to get Fannie and Freddie back into the game, as it were, and to at least to some extent return to the old days, and that's just human nature.
Yeah.
We've seen that multifamily starts have increased. We're up. It was just announced today, 12.5% month over month, which was a huge unexpected increase. But the problem is in single-family homes, there's not enough capacity there. There's not enough supply coming onto the market. So prices are rising across the board. And that is not very well tracked by any major inflation measures. The Fed is trying to get to 2% inflation, but it's the cost of housing in the major inflation indices is calculated as owner equivalent rent and not the actual cost of housing. So it's kind of buried within the inflation indices, and it's one of the biggest factors of lifestyle expenses.
So my final question, Mr. Lundin, you host the New Orleans Investment Conference, which has witnessed many top-level names. Without going into specific details, have some of these top-tier individuals and investors discussed their personal concerns to you about the economy?
Yeah, and I've been fortunate to have some great conversations over the years. I was able to talk about the euro and why Britain wasn't joining the euro currency with Margaret Thatcher. I had a conversation with Alan Greenspan a couple of years ago about the debt, and he said the problem is much worse with the derivative positions of the too big to fail institutions that absolutely dwarfs the size of the federal debt, and that the government has essentially backstopped those derivative positions that could amount to over a quadrillion in nominal impact. We have conversations all the time. One of the great things about the conference is the ability of attendees to mingle with these speakers. You'll walk the halls, you'll see people talking with Rick Rule about their mining stock positions, their specific positions. They'll be talking the problem with the debt with Peter Schiff. It's really an amazing thing. Our speakers are very willing to mingle with our attendees at our social events and in the hallways and take questions. And in our Gold Club is a Q&A session that for most of our speakers where you can ask follow-up questions on their presentation. So it's a remarkable opportunity to get advice from the top experts in the world and get your specific questions answered and really just get to know these people.
I could honestly pick your brain for hours, but unfortunately we're out of time. But before we go, was there another place our audience can learn more about your work or any upcoming news items you would like to share?
Absolutely. The New Orleans conference is coming up November 1st through the 4th, so they can go to neworleansconference.com to learn all about that. And they can learn about Gold Newsletter at goldnewsletter.com. We do have on both sites, but really it's more prominent on the goldnewsletter.com site. We have a banner where you can click on to get a copy of our Investor's Guide to Gold and Silver. It's an objective 30-page report that covers every aspect of metals and mining investments.
Mr. Lundin, it's been a true pleasure. Thank you so much for being with us at Smart Money Results.
Great talking with you, Joshua.
Thank you.